Always great to see you.
Same, Tyler.
All right, tell us what you see. Obviously, monetary policy can't solve everything. It can solve monetary policy. It can do a lot about liquidity. It can juice the lending sphere. But why do you think a too aggressive stance on inflation is such a danger overall, and how would it play out?
Well, I mean, for one reason, as you point out, it just simply won't fix everything. And in that article or commentary that you noted, I point 5 or 6 different areas that simply monetary policy cannot address. It cannot address the shortage of goods that we have, whether it's computer chips, whether it's automobiles, whether it's high prices for used autos, whether it's housing, which is 5 million units short. There are a whole host of things that the Fed can't do anything about. 3 million people retired early, 1 million women still out of the workplace, 900,000 people died from COVID. Not all of them were in the workforce, but it has affected labor force in ways that monetary policy simply won't address. So while I'm fine with the Fed beginning the process of normalizing policy in a transparent, measured, and careful fashion, the folks who are calling for 50 basis point increases in every meeting, a rate hike, and simultaneously selling bonds to reduce the size of the balance sheet when we're running trillion-dollar deficits, to me, sounds like a much more dangerous game than if the Fed were extremely methodical and clear about policy going forward.
So, Ron, I'm going to play devil's advocate with you a little bit, and that is you can make the argument that inflation is becoming more broad-based and expanding out into other areas of the economy as well, where maybe perhaps Fed policy and also fiscal policy have helped to juice some of that price appreciation we have seen. So that's one piece of the puzzle. The other is this idea that maybe the Fed is behind the ball as it is, and speaking to some Fed officials, whether it's on the record or on background, that they really have a credibility situation that's on the line now, too. So you're still saying move, but not move aggressively.
Yeah, and I doubt the credibility issue far more than other people would suggest, simply because, again, if you disaggregate everything that's transpired, Morgan, over the last 2 years, much of the inflation has come, in my opinion, still from these pandemic-induced disruptions, and also from the lack of new home building and things like that really stretch all the way back to the great financial crisis, the delayed family formation that we've seen in the U.S., the slowdown in population growth. Last year, it was the slowest in the history of the republic. So, the Fed could do a lot of these things, but they're not behind the curve on demographics. They're not behind the curve on supply. We need those things to right themselves. I expect some of that will take care of itself by the second half of the year. And if the Fed gets very aggressive, they may be too far in front of inflation and tip us over some way or another, and do more harm than good over the course of a 6 or 7 month
So that's
period.
what I wanted to drill down on. I'll stipulate that the Fed can't help all of these areas that you've very ably laid out, like the shortage of computer chips, the shortage of housing units, the lack of labor, the low birth rate, and all of that stuff. Yeah. Lord knows the Fed can't do anything about the low birth rate. But let's talk about
you and I can't even do anything about the low birth rate.
No. But what is the danger of the Fed overreacting and getting too tight too soon?
Yeah, well, the economy is going to slow a little bit this year. Now, some are saying 3.5%, and that's fine. That's good growth rate. But remember also, and Morgan referenced this, fiscal stimulus, that's gone now. That those $300 checks that went out to families with children expired in January, and we just have new data out today that we've seen a 45% increase in the poverty rate. Last year, we reduced poverty, particularly among low-income families. And as your prior guest said, the people who benefited a lot during some of the experiences that we had during the pandemic were in the upper, quintile or quartile of income earners. So now you have the lower quartile losing those supports that propped up the economy. The savings rate peaked at 35%. It's under 8%. That excess savings was at $2.5 trillion. That's come down. So we're going to have, it's hard to say we have tight fiscal policy running trillion-dollar deficits, but the tailwinds are turning into headwinds. And I think that becomes a two-pronged risk, particularly in a period, and we've talked about this now, Tyler, as you know, all year, the added geopolitical risk that could upset the global economy.
Well, that one is looming, and we'll go into the weekend with, watching what's happening. Ron Insana, thanks very much. We appreciate your time.